Benjamin Franklin, one of the founding fathers of the United States, once said, "In this world, nothing can be said to be certain except death and taxes." Well, if an entity earns a profit, it inevitably has to pay taxes. Even for individuals like you and I, we will be taxed if we have a source of income. The amount of tax to be paid depends on the tax law. In Singapore, the tax authority is the Inland Revenue Authority of Singapore. In Singapore, a company is taxed on the income earned in the preceding financial year. For example, income earned in the financial year 2019 will be taxed in 2020. The year of assessment is the year in which income is assessed to tax. To assess the amount of tax, the tax authority looks at the income and expenses during the financial year. This financial year is known as the basis period. The basis period is generally a 12-month period preceding the year of assessment. You may look at the examples in the table here. With effect from year of assessment 2010, a company is taxed at a flat rate of 17% on its chargeable income, regardless of whether it is a local or a foreign company. Please note that chargeable income is the profit for a period determined in accordance with the rules established by the tax authority upon which income taxes are payable. To help companies lower tax payable, all companies in Singapore enjoy the following tax exemption scheme. New companies are companies that operated for less than 3 years. Besides the tax exemption schemes, a corporate income tax rebate is given to all companies to further ease business costs, regardless of how long the company has operated for. The difference between the tax exemption scheme and the corporate income tax rebate is that the tax exemption scheme decreases the chargeable income. The corporate income tax rebate directly decreases the tax payable. A company's chargeable income will be different from its accounting profit, which is the profit according to the financial statements. This is because some expenses are not deductible for tax purposes. Similarly, some income earned are not taxable. To prepare a tax computation, the company will start off with its net profit before tax. Then, we will deduct non-taxable income, add non-deductible expenses, less capital allowances, tax losses from previous years of assessment, approved donations to Institute of Public Character, and we will arrive at the chargeable income. Just now, I went through the tax exemption scheme. We will deduct that from the chargeable income to arrive at the taxable profit. Afterwards, we will multiply the taxable profit by the tax rate of 17%. Lastly, we will deduct the corporate income tax rebate to get the tax liability for the company. Well, I understand that several terms here sounds daunting. Not to worry, in this video, I will only go through the items in orange. We will start off with taxable and non-taxable income. So here, income is taxable if it is accrued or derived from Singapore or received in Singapore from outside of Singapore. So, this includes any type of income. However, some income are not taxable, so this includes capital gains, which includes the gain on sale of fixed asset and gain on foreign exchange on capital transactions. Also, certain types of income are specifically exempted from tax, and I would like to draw your attention to the most common one, which includes dividends, branch profit, and service income received by a company in Singapore. Now let's take a look at expenses and whether they are deductible or non-deductible. So here, as you can see, deductible business expenses are those that are wholly and exclusively incurred in the production of income, and it must satisfy all these criteria. On the other hand, non-deductible business expenses are activities that do not fulfill the criteria above. So this may include things like personal expenses or capital expenses. So let's take a look at some of the common deductible and non-deductible business expenses. So amortization is not deductible. And let's see, depreciation is not deductible. Instead, the company will claim capital allowances, which is actually depreciation, but according to the tax law. I will cover that in a short while time. Fines and penalties are never deductible. Non-trade or capital transactions, as I mentioned earlier on, and this would be legal and professional fees. Any expenses incurred on S-plated cars are not deductible. So let's see. General provisions are not deductible. So these are some of the few common expenses that are not deductible. Earlier on, I mentioned that depreciation expense is not deductible for tax purposes. Instead, the company will claim capital allowances, which is actually depreciation, but according to the tax laws. A company can choose different options as to how it wants to claim capital allowances. The company can claim capital allowances based on Section 19 of the Income Tax Act, where the asset is written over the prescribed working life of the asset in the 6th Schedule of the Income Tax Act. However, most companies claim capital allowances under Section 19A, low-value assets, which is something that costs $5,000 and below, as well as prescribed automated equipment like computers, laptops, printers, and software, can be written off in 1 year. Other non-current assets will be written off in 3 years. After you have made the necessary adjustments and prepared the tax computation, you will arrive at the tax liability. The journal entry to record tax liability for the current year is to debit taxation and credit provision for tax. Taxation is an expense which will be deducted from the net profit before tax in the income statement to derive the net profit after tax.